Hey, it's Eric, and in this video, we are going to look at a short-term credit spread trading system for SPX. We're going to be looking at 7 DTE or 7 days to expirations credit spreads, both put spreads and call spreads. And it's all centered around some simple moving averages, actually exponential moving averages, the 8 and 21 EMA. We're going to go through all the details. And this is sort of an extension of some of the other 7 DTE research we've been doing. But as you'll see in a minute, these really go together, and it's going to allow us to continue to trade as the market fluctuates, up and down. We can't always do bull call spreads, as you know. There are little pullbacks. So let's go over just a couple things real quick. And this might be a recap for some of you guys, but essentially the whole point of trading short-term spreads is to increase our frequency of high probability trades. We're going to be using backtest along with out of the money spreads to still have a high probability. And what we're trying to do too is take advantage of SPX's 3 expirations per week. SPX has a couple benefits. There's no early assignment. There's the 60/40 tax break. You guys can look into that if you're interested. And we want to trade short-term spreads without having to watch the market all day. That's something I think is really important, especially if you're still working a day job or can't be on the computer, 24/7. Since all of this data is based on end of day option pricing and backtesting and such, then you're going to be looking to take these trades closer to the end of the day. It doesn't have to be right at the end of the day, but anytime after 2 or 3 p.m., right, within an hour or so of the market closes, then you can look to put on some of these trades. The other thing we're trying to do too is identify a mathematical edge, and you're going to see that in the results and in the study here in a minute, because we want it to be very clear. We want to check our phone or get on the computer and say, okay, it's 3 o'clock. The market conditions there. I know my edge. I'm going to sell this delta, yada yada. It's going to be very clear. There's going to be no question of whether or not you should take a trade or not. And typically with credit spreads, we want to know our risk, and the credit spreads, just by selling a put and buying a lower put, we know exactly what our risk is. It's defined risk. That's the whole part of vertical spreads. And we're going to know our targets and our stop loss orders, because I'm going to share that with you in each trading strategy. But I want you to understand a couple things first too, is if you're new to credit spreads or vertical spreads in general, I really suggest you kind of, we're not going to cover it in this video, but you really need to understand how much you're risking each trade. And, there's max loss and max gain, and we're going to be talking about those things because a lot of our exits and profit taking and stop losses are based on those numbers. So you really need to understand that. I'm going to kind of gently cover it here, but make sure that you understand what your risk is. And basically, there is a max loss. And it is, rarely is that going to happen in these trades, but it's always possible that you wake up one day and there's some kind of news event, whether the market runs to the upside or the downside. Max loss is always possible when you're trading spreads, especially if there's only 7 days to expiration, right? Even if we're using stop orders. So another part is when we're looking at mathematical statistics and probability, you can't just choose the trades you want to trade big and trade small. You need to trade a consistent size so that you can let that mathematical edge work out over time. And that's how you gain consistent profits, trading a consistent probability strategy in consistent size. Doesn't mean you can't scale up over time and maybe you start with one spread or one contract, or then you switch to 2 spreads and 3 spreads, but you don't want to say, oh man, I really think this is going to go higher, and you sell 5 spreads one day, because that loser is going to kind of take away from the consistency that we're talking about, right? And also understand that with any system, there's going to be winning and losing streaks, which is, kind of circles back to you need to know how much your risk is in proportion to your portfolio. We're not going to dive into portfolio sizing and all that stuff, but as long as you understand what your risk is and understand that there can be consecutive losers in a row and consecutive winners in a row, you need to be prepared to take those losses as the market changes its character, okay? About the backtest information, if you've been with me for a while, I'm using CML Trade Machine for this 7DT research. As we know, backtesting has its pros and cons. and it's really meant to be a foundation. The numbers we're going to look at are theoretical, but the probabilities are correct, but they're still using end of day pricing, and there's other factors in slippage, and now commissions aren't that big of a deal, but commissions used to be a bigger deal. The other thing I want to point out here too is even though there's 3 expirations per week, the backtesting software can only take one trade at a time, and we're going to be considering taking overlapping trades. For example, if there's a market condition that says, hey, it's short-term bullish, we might open a put spread that expires in 7 days on a Monday, and then if the condition still exists, we may open another one on Wednesday, and then maybe we open another one on Friday. So you might get 3 trades in a week if the condition's right. The back testing, though, is not going to do that. It's going to open the trade on Monday if the market condition exists, and it won't open another one until the following day. So I want you to keep that in mind when we look at the results of the back test, that the trade frequency should be higher, because we're not looking at, like, when the MACD crosses the RSI or whatever. We're not looking at that. We're looking at a market condition saying, hey, is the market bullish? Yes. Okay, we're going to sell bull call spreads until the market's no longer bullish. Okay, so just keep that in mind with the back test. It's only trading one at a time, where we might take 2 or 3 trades at a time, overlapping. As always, past performance does not indicate future results. And one of the things about the time frame, we're going to be looking at 5 years of back test as of, I'm doing this video the end of 2019. We got another month or so left in the year. Weekly options didn't exist 10 years ago like they do now. So when you try to back test weekly options, it may take an option that's 20 days away. It's going to try to find the closest one to 7 days. So for a consistency standpoint, I'm only looking back 5 years, and that's going to get us close to truly trading a 7 days to expiration spread. So that's why I'm only doing 5 years, even though I can do 10 years. It's not going to be accurate in that sense, because 10 years ago, there weren't 3 expirations per week, you know what I mean? And the liquidity is actually better now than it was too. So there's some, variables there that you just can't bring into the future or bring into the present. So I just wanted to give you a little bit of information about the back test. So let's talk a little bit about the 8-21ema system. I didn't come up with a fancy name for it, but I could probably come up with a better name. So maybe I'll rebrand that or something. But anyway, we're going to be using basically 3 moving averages, and it's primarily based on the 8-EMA and the 21-EMA. But to avoid some bear market scenarios, 2 of the 3 strategies, we're going to be using the 200-day moving average, and basically just says, and you'll see it here in a minute, that we just want to make sure we're above the 200-day moving average, because once the bear market comes and the 21, these moving averages go under, the nature of the market changes, and we're going to want to get out of this of 2 of the 3 systems. One of the systems is fine, and we'll talk about that here in a minute. There's 3 systems, as I mentioned. They all use the same 8-EMA and 21-EMA. 2 of the 3 also use the 200 SMA, and we'll look at that in a minute. And really what we're looking at is with those moving averages, there's a couple things. So first, we're mainly looking at where the price of the SPX is going to close. So is it going to close above the 8-EMA? Is it going to close below the 8-EMA? So that's one of the factors. The other factor is to see what is the relationship between the 8-EMA and the 21-EMA. Is the 8-EMA above the 21? If it is, that indicates a little bit more bullishness, because the near-term price action is averaging higher than the longer-term price action, in this case the 21, and vice versa. If the 8-EMA crosses down over the 21-EMA, then that kind of implies that the market's bullishness is starting to fade a little bit. So those are the main sort of factors we're going to be focused on, and the position of those moving averages and where SPX closes is going to help us dictate what spread we're going to open. Is it going to be a bull spread, a bear spread, and we're going to have our profit taking and exit strategies that go along with that. Okay, so that's a little bit about just kind of an overview of the system. Okay, so let's look at system number 1, and I'm using the word system kind of loosely here. System number 1 is kind of bull mode put spread. So, and by bull mode, I mean the market is bullish and we're looking to sell put credit spreads until the market is no longer bullish. And the market condition to define this is when the 8-EMA is above the 21-EMA. So that means the shorter term price action is above the 21, And two things need to exist. The 8 is above the 21, and SPX is going to close or looks to close above the 8 EMA. So the market's very bullish. The market's closing above the 8. The 8's above the 21. We're going to want to sell bull put spreads. And because and the reason I put bull mode is because we're actually going to look to sell low delta 40. This is very close to the money. It's not comfortable. I'm still getting used to it myself. I'm from the old school, or whatever you want to call it, where I'm selling delta 20. Well, guess what tests better? Delta 40, Delta 41, Delta 42, and you're going to see this in a minute. So when we're in bull mode, we're going to be selling closer to the money put credit spreads with 7 days to expiration. We're going to have two main exits here. Whichever one comes first, we're going to try to close the trade. If we can get 75% of the max profit, then we will close the trade. That's sort of the target. And exit number 2 is we're going to close that trade after 5 trading days. I know in previous videos I had mentioned calendar days. I've verified this with the backtesting, and we're going to be looking at closing the trade within 5 trading days. That's essentially, you're going to close that trade before it expires. So we're not holding anything through expiration. So 5 trading days is basically 1 week, right? With this strategy, two things. We're not using stops. We're looking to just collect the 75% or close it after 5 days, which could be, half, 50% or something. Or you could be in a loss. You would close it for a loss before it expired, so you're not closing in the money. And again, we can consider selling overlapping trades if conditions exist. For example, if the market condition up at the top exists, we could sell one on Monday and then sell another one on Wednesday, sell another one on Friday, and keep doing that until that condition doesn't exist. And when that condition doesn't exist, that means that eventually the market pulls back and it's going to close below the 8 EMA, and then that would negate opening any new put spreads. The other thing I'll point out with here, this is the one strategy that does not use the 200 SMA, so it's not looking at the bigger term time frame. We're really only concerned with the 8 and 21 EMA. All right, so let's just take a quick look at what those results are. And this is going back 5 years. And again, I put, you'll see here the Delta 44, Delta 43, 42. We're all selling Delta 4s. And the reason I put this here is because the reality is when you go to let's say the market condition exists, you go to your option chain, you might see a Delta 39 and a Delta 42. There may not be a Delta 41, even though in this particular day, or I did the back test, Delta 42 performed the best. You might not have a Delta 42. So what I'm recommending, or what I'm looking to trade, is Delta 40, 41, or 42. Oh, this is actually supposed to, yeah, this is Delta 41. So I would trade any of these three, whichever one's available, because again, not all of them are going to exist. And the conditions are the stock is above, in this case SPX is above the 8 EMA, and the 8's above the 21. We're going to close the put spread with 75% limit close in 5 days. And real quick about the 75%, if you sell a credit spread for $1, 75% of the max profit is $75. So you would look to close that trade when you could buy it back for $25 or 25 cents. So again, the max profit is 75. So once you reach that, that means the spread has gone from $1 down to 25. So you want to buy it back for cheaper. It's a little bit in reverse for those that are new, but that's in general how we're going to be looking to take trades is based on that max profit. In this case, it's 75%. So again, when the market is above the 8 and the 8 is above the 21, I'm looking to sell a low Delta 40 put credit spread that expires in 7 days, and I'm going to close the trade, whichever comes first, within 5 days, trading days, or 75% max profit. And these are the back test results for the past 5 years, and this was, I basically did this around November 2019. Okay, so let's talk about system number 2. System number 2 is very close to system number 1, but the difference is the market has now started to pull back, and by pull back I mean close below the 8 EMA. When that happens, we're going to look to sell a bear call spread. So the condition is when the 8 is above the 21, so we're still in a bullish mode, and the 21 is above the 200, and this is where we're going to bring in that 200 moving average. We want to make sure that the shorter term action, the 21, is still above the 200, And third condition, SPX is going to close below the 8 EMA. So before, when the market's closing above the 8 EMA, we're selling bull put spreads. But now, as the market starts to pull back or turn lower, we're going to be selling bear call spreads for this condition. And we're going to look at this on a chart. And now I just want you to think about this for a second. When you're selling bull put spreads, you may still be in a bull put spread, and then the market starts to turn lower. So you might have to start losing money on the bull put spread, but you're now bringing in bear call spreads, which is going to hedge and offset some of your bull put spread money, and you can start to make money on the bear call spreads. So this system works together. It's made to sort of track the market. So as the market turns lower, you're going to adjust the strategy, and then we'll look at the system 3 here in a minute. But so when you're in bull mode and then the market closes below the 8, you're then going to sell a bear call spread, and we're going to sell a delta 30. It's a little bit more room to run. A delta 30 spread with 7 days to expiration. This is a little bit closer to the Tasty Trade style, right? They still sell farther, but delta 30, 7 days to expiration. We're going to close the trade if we reach 50% of the max profit. So again, let's say we sell the spread for $1. Once the spread loses value down to 50 cents, we would buy it back for 50 cents. That's 50% of the max profit. Exit number 2 is a 200% max profit stop loss. So if we sold it for $1 and the spread increases in value to $300, so 200% of $1 is 200. So you would buy that spread back at $3 for a $200 loss in this case, and that would avoid the $400 loss, which is actually the max loss, right? So we're going to minimize that. And the reason why we need to do this, because when you sell farther away from the money, you get less credit, and therefore the risk is greater. So we're actually going to use a stop loss order when we're selling these delta 30 spreads, okay? And again, we would close the trade after 5 trading days if neither the first 2 exits were to hit. Okay, so real quick note in this one, again, we're using the 200 SMA as a bear market filter, and we can still consider selling overlapping trades. We could sell multiple bear call spreads if we're closing below the 8, but the 8 is still above the 21 EMA. So let's take a look at what those results look like. And I circled the delta 30 strategy because that's the one that I plan on trading. But I just wanted to show you, selling delta 40, you can see the win rates are a lot lower. Here we ended up with an 80% win rate using these stop loss and target parameters. And again, 80% win rate selling a delta 70 option. I'm sorry, a delta 30 option, that's the edge. So when you sell a delta 30 option, that means there's a 30% chance it expires in the money. So it's not very likely, which implies there's a 70% chance that it won't. Well, we're getting an 80% win rate. So that 80% versus the 70%, that's the edge of this trade. And again, we're going to be overlapping these trades with bull put spreads. So you'll actually start evening out or making money on the way down as you take some losses on the bull put side. Okay, so that's why these are designed to work together. Okay, so let's talk about system number 3. This is a contrarian bull put spread. And the reason why it's contrarian is because now the market has moved even lower, so much that the 8 EMA is now trading below the 21 EMA. If this happens, if the 8 EMA is below the 21, but we still want the 21 above the 200, and SPX is going to close below the 8, so we've gotten a little bit bearish, but not so bearish that we're trading below, that the 21's crossed below the 200, we're going to look to start selling bull put spreads again. And that's why it's contrarian, is the market's gotten bearish, but since it's still above the 200, we're going to go with the idea that the market is going to rebound, or at least not keep going lower. We're going to, again, sell a delta 30 put credit spread. This time we're going to be able to look at taking 75% of the max profit, and again, a 200% max profit stop loss, and close the trade after 5 days. We're using the 200 as a bear market filter again, and consider selling overlapping trades. So let's look at this one. So the stock is below the 8, the 21 is above the 200, so we're not completely bearish. and the 8 is below the 21. So we're going to sell bull put spreads at around delta 30. We're able to collect a little bit more profit. This was more profitable than 50%. And again, we're going to close after 5 days, and we'll still use that 200% stop loss in case the market really falls out of bed, and then we'll have a stop loss in place for that particular trade. So that is the market condition for system number 3 based on the 8 and 21. So just to recap, we have system 1 bull mode where we're above the moving averages, and the 8 is above the 21s. We're selling close to the money bull put spreads. As the market starts to pull back, we're going to put in some bear call spreads. And then as the market kind of rolls over a little bit, and we'll look to sell bull put spreads again. So that's kind of the system. And then if it rolls back up, then we can end back up in bull put spread mode. So let's look at a chart real quick, and let's just kind of visually see what this is going to look like, right? So I just took a little snapshot in time where you can see the market kind of rallied up and then rolled over and then rallied back up. So this blue line is the 8 EMA. This purple line is the 21 EMA, and then you have the 200 way down here. So we're still in a bull market because we're above the 200. So all 3 systems will be in play if we're above the 200. So in general, you can see that the market started turning back up. So in this particular, I don't know if that one actually crossed, but in this particular candle, the price is above the 8 and the 8 is above the 21. So we're selling delta 40 put credit spreads. And that condition exists all the way through these candles. Until this candle, that market condition exists. So if you're doing that, you can sell, let's just, I don't know what day this was, but if this was a Monday, you could open one, and then Tuesday, maybe you leave it. You probably hit your goal on that with that gap up. Wednesday, you open another one, right? Thursday, you open, and Friday, you open another one, and you just keep going, right? And then eventually, you might be in a couple trades, and then this happened. The market closes below the 8, but the 21 is still, the 8 is still above the 21. So on this particular candle, you would say, okay, now I'm going to sell a delta 30 bear call spread because the market is no longer showing strength because it's closing below the 8. And so then you have a small period of time where you could open up a couple trades where we're below the 8, but the 8's still above the 21. So again, if you sold a couple bull put spreads up here and the market rolls over, you could experience maybe not max loss, but you could lose money on these trades, but then you start making on these trades to offset those losses. And then as the market rolls over, the 8 actually crosses down. At this point, now you're selling bull put spreads again with the idea that the 200-day we're in a bull market and this thing should recover. Obviously, that cannot happen. We're only back testing 5 years. If we get a true bear market, then you can make some money on your bear call spreads. But then as soon as you start the bull put contrarian mode, you could actually take some losses there, and then you're out of the system until the 8 EMA crosses back above, and then you're back in bull mode and you're selling bull put spreads again. So that's kind of just a quick snapshot of what can happen. This is one. I thought this was a good illustration of how you can sell for a few weeks, be selling bull put spreads, and then it rolls over. You get a few bear call spreads in, it rolls over, bull put spreads, and then as it gets back above the 8 and the 8 crosses up, instead of selling the delta 30s, you're back up to selling delta 40s as in system number 1. So that is the 8-21 EMA system for selling SPX bear call spreads and bull put spreads, depending on the position of the market and where the price closes. If you have any questions, I'd love to hear them in the comment section, and we'll see you at the next video.